Welcome back. Price increases in Singapore are slowing down. January's latest core inflation print hit 0.8%, its lowest since 2021. Headline inflation, which includes accommodation and private transport costs, also eased to 1.2% on year from 1.5% last month. Both figures are lower than what economists had expected. A lower inflation was recorded for the majority of categories in January. Prices of retail and other goods fell to negative 0.6% compared to a 0.5% rise in December. Electricity and gas prices also rising at a slower pace. Only private transport costs increased due to higher car prices. It rose to 2.8% compared to 0.9% decline the previous month. Now, for the full year, inflation is expected to average 1.5 to 2.5%. Imported inflation could also be moderated with the appreciation of the Sing dollar and stable global commodity prices. But market watchers say much of this depends on whether tariffs imposed by the U.S. administration will result in escalating trade tensions.
Global trade policy uncertainty might result in a global economic slowdown, and that would, in that sense, hurt imported prices for Singapore, therefore posing some downside risk to Singapore's imported inflation. But overall, I think what this means is that inflation in Singapore is going to be much more contained.
Singapore has also rebased the Consumer Price Index, or CPI. The base year is now 2024 instead of 2019 previously. The rebasing exercise is conducted every 5 years to reflect the latest consumption patterns of Singapore households. Now, the top three expenditure groups remain as housing and utilities, food and transport. Together, they make up 62.9% of components of the CPI, somewhat similar to that in 2019. Healthcare takes up a bigger share of over 10%, and that is up from 6.5% in 2019. Recreation, sport and culture drops below 6%, with education at 5.8%. Well, let's get more clarity on the changes to the basket of goods and services used to measure inflation. For that, I'm joined by Suan Teck Kin, Head of Research at UOB. Welcome, Mr. Suan. Now, what does this rebasing mean? We talked about it briefly, but elaborate on that for us. And how does it impact the way we think about consumer spending moving forward?
Right. This rebasing is a standard practice by statistics agencies to adjust the consumption basket every certain number of years. For example, in this case, 5 years. I know other countries do that. So it reflects the changes in, for example, preferences of people, how they spend and what they spend on the average household. And also it reflects on the demographics changes. For example, in an aging society like in Singapore, the number of over 65 has increased from about 16% from the last survey. Now is about 20% share of the population. So obviously, I think there's some changes in the spending pattern. So as a result, what the numbers show today is also reflection of partly of these changes in the spending pattern. For example, in the chart just now, the housing and utility is the biggest part. In fact, the housing component has gone up from about 20% to 25%, just the accommodation alone, not the housing utilities. And the other big changes is actually on the private transport, where the share has dropped from 12% to about 9% share of the spending basket. So that these are the big changes that resulted in the so-called disinflation number that we are seeing today as part of the factor.
Understand. Now, at the same time, what problems should we be on the lookout for if inflation drops too fast?
Right. If inflation drops too fast, that would be a big problem too. So we don't want to have extreme cases of high inflation or inflation dropping too fast. So if inflation dropping too fast, you have a situation where it's deflationary. That means prices are actually declining. So when you have prices declining, that's a very dangerous thing because, for example, the normal reaction for people would be is that, oh, tomorrow prices will be lower, so I'll wait a bit, right? So I'll delay my spending. Now, when it happens with the companies will say that, oh, the demand is now falling because people are holding back. And then the investments will start to slow down and also production will start to be cut back. So you have a situation when prices fall too much and becomes negative changes or falling prices, then you have a deflationary environment, and that will be is a very dangerous situation where the whole thing will spiral downwards. Demand comes down, income comes down, prices drop, including asset prices like house prices as well, at risk of falling.
When you look at the latest figures, are we in a position to say that this period of high inflation that we were all worried about is now well and truly behind us, or not quite yet?
Well, hopefully so, Jill. All these are quick increases or fast increases in terms of prices that we saw, particularly the year before after the recovery from COVID. Hopefully, I think the situation is so-called under control with price increases to be more moderate this year. Now, I think the price increases itself, it is not a sin, right? It's not something bad. But as long as the price increases are moderate, I think that's where companies can make money and employees can get the pay rises and those are good stuff. But if prices go too fast and that's out of control, that's a situation that we want to be cautioned of, and we want to prevent that situation from happening. And MAS has strengthened the Sing dollar, and that partly also put us in a very good position in terms of seeing moderate increase in prices, and hopefully that can continue on, Jill.
Yeah, if we continue on this moderate trajectory, do you have any further insights into the forecast for the year ahead?
I think for this year, I think the price increases should be more moderate compared to last year. We are expecting about 1.3% or so for the full year in terms of inflation rate. Last year, we saw about 2.4 to 2.8% for the core and headline, the core number. So that is about half of last year's pace. And these moderate price increases are what we have used to see in the good old days, where price increases were not increasing that fast.
A couple of question marks that we still need to look out for, and that is the knock-on effects from the Trump administration tariff threats. Speak to that.
Well, I think the Trump, I think particularly for Singapore as an open economy and vulnerable to shocks to the global trade system, I think the Trump trade tariffs direct effect on Singapore, not that significant. That means Singapore will not be unlikely to be targeted by Trump. But we want to make sure that we are not affected if these trade tariffs applied to other countries and results in, for example, slowdown in global trade. That could hurt Singapore and our companies and our people as well. I think we'll have to be watch out for that.
Very quickly, just your take on the monetary policy in the months ahead.
Well, with this inflation environment that is hopefully we are in right now, I think the MAS has a lot more flexibility in managing the Sing dollar, the trade-weighted Sing dollar. So for now, we are still seeing MAS holding on to the policy unchanged, but there's a risk with the disinflation if it continues on. I think there's a risk that the Sing dollar MAS might so-called weaken a bit or slow down a bit of the appreciation of the trade-weighted Sing dollar.
Okay, Mr. Suan, really thank you for your insight and your input there. I've been speaking with Mr. Suan Teck Kin. He is the head of research at UOB.